investors, and welcome to your Stock Sense morning brief for Friday, November 7th, 2025. I'm Malik, and today we'll unpack a market that's still searching for its footing after a turbulent week. After Wednesday's sharp sell-off, the KSE 100 finally caught its breath. The index closed about 480 points lower, settling near 159,100, a mild 0.3% dip. That's less than a third of the previous day's drop of 1,700 points. You could say the market exhaled, but it's not quite ready to smile yet. Trading volumes told a different story. Investors were active, with nearly 960 million shares changing hands, almost triple Wednesday's total. The traded value crossed 30 billion rupees, showing that despite caution, participation remains strong. The breadth, though, was still negative, about 200 advancers versus 230 decliners, with 50 unchanged. Meanwhile, under the surface, sectors sent mixed signals. Textile composites provided a welcome push, showing resilience and some buying interest. But glass and ceramics dragged sentiment down, erasing early gains. Elsewhere, autos and energy names traded quietly as investors waited for clarity on policy direction. Technically, the KSE 100 is giving off short-term caution vibes. The 10-day, 20-day, and 30-day moving averages are flashing sell signals, though the long-term 100 and 200-day averages still point to underlying strength. Support sits around 155,300, while 169,000 marks the next big resistance level, a zone where buyers and sellers are likely to test each other again soon. On the corporate front, today brings a flurry of board meetings. Sitara Energy Limited has two lined up, one for its annual accounts and another for quarterly results. Dewan Mushtaq and Dewan Khalid textile mills are reviewing their third quarter accounts, while Sitara Peroxide wraps up its annual review. These may sound routine, but they often set the tone for sector-specific moves, especially in the chemicals and textile space. Today's also the last day of entitlement for two big dividend distributions. Hub Power Company is offering a 50% interim payout, and Pakistan Petroleum Limited is giving 20%. That means investors holding these stocks by today qualify for dividends. New buyers tomorrow won't. Now, zooming out, the economic picture is a blend of optimism and challenge. The government's economic team unveiled its progress report on structural reforms, focusing on privatization, tax efficiency, and deregulation. Finance Minister Aurangzeb confirmed moves to deregulate the sugar and wheat sectors, signaling less state control and more market discipline. And there's buzz around a shift from the final tax regime to the normal tax regime for exporters, especially textiles, a move that could reshape how exporters plan growth. And there are bright corporate stories too. TRG Pakistan reported profits nearly tripling in the July-September quarter, a reminder that innovation-driven businesses can still outperform in a tough environment. On the capital markets side, a small but symbolic step. The Pakistan Stock Exchange now allows guardians to open trading accounts for minors. It's a move toward financial inclusion, planting the seeds of investment habits early. But not all the news is easy listening. A leading think tank has warned that Pakistan's tax burden is becoming unsustainable, slowing business activity and, if left unchecked, threatening economic momentum. And as expected, NEPRA's new quarterly tariff adjustment has ended the relief era, pushing energy costs higher for both consumers and industries. That could compress margins for manufacturing and dampen household spending in the months ahead. Adding to the pressure, foreign direct investment continues to waver. Qatar's Al Thani Group is preparing to divest its stake in the Port Qasim power project, yet another sign of how tough it's been to retain long-term foreign investors. And the situation at Pakistan International Airlines remains turbulent, with senior dismissals and ongoing flight disruptions feeding uncertainty around its privatization process. Turning to flows, foreign institutional investors were modest net sellers, trimming about $0.9 million in equities. But locals stepped up to absorb the pressure. Individuals led the charge, buying roughly $6.6 million, while companies added another $4.8 million, and broker proprietary trading chipped in $2.4 million. On the other side, mutual funds were the biggest net sellers, unloading around $6.7 million, joined by banks and insurers. So, what's the takeaway? My sense is that the market is standing at a crossroads, with reforms and optimism on one side, and inflation, energy costs, and investor skepticism on the other. The government's push for deregulation and transparency is encouraging, and stories like TRG's strong results show resilience within the private sector. But confidence, especially from foreign investors, is still fragile. For now, local participation is keeping the market alive. It's a reminder that even in uncertain times, Pakistan's investors haven't lost their nerve, just their margin for error. That's all for today's Stock Sense Morning Brief. I'm Malik. Thanks for starting your morning with us. Stay curious, stay disciplined, and we'll catch up again tomorrow with more from the Pakistan Stock Exchange.